Mr. Greeting you. But Avinash, there are these top 4 private sector banks, right? And it is also good sector or good zone to be in. But how can one actually choose which of these private sector bank actually stand out, be it HDFC Bank or ICICI Bank, Axis Bank, as well as Kotak Mahindra Bank? There are a choice of plenty, but how should one actually look at these counters when it comes to fundamentals?
Good morning, Cheryl, and good morning, Vineet. I think clearly, all the 4 banks which you mentioned in the private banking space are definitely poised for stronger growth ahead. But if you see the positioning of the banks, I think Kotak is a relatively smaller player as compared to SDFC or an ICICI Bank or an Axis Bank. Most importantly, Axis Bank has got a smaller balance sheet as compared to SDFC Bank. But in terms of the return on assets, return on equity, as well as the NIMs, SDFC Bank scores definitely better. ROA for Axis Bank will take a lot of time to recover. But as far as ICICI Bank is concerned, I think we find it to be the most attractive because recently in the analyst meet day, they clearly commented that they are now poised to become a fintech bank, and digital is going to play a very important role. So I think investors should look at banks which have got a diversified kind of a business mix, both retail, corporate, as well as other businesses like insurance, broking, general insurance, life insurance. So I think that definitely ICICI Bank covers it pretty well. In terms of the valuations also, I would believe that ICICI Bank looks pretty attractive considering that the loan book growth, the deposit growth has been very robust. And most importantly for all these private sector banks, the credit growth cycle is now in a very uptick stage. In fact, we are now seeing credit growth of almost double digits, which eventually means that corporate capex is also going to get geared up. So I think if one were to choose amongst all the 4 banks at the current juncture, I would prefer ICICI Bank. We have a coverage on the stock and we feel that the fair value could be at least 870, 875 over the next 12 to 18 months. So I think the market correction has provided a good opportunity for investors to get into such quality large size banks where the risk management and the risk control is minimized. And I think they have very solid balance sheets at this point of time, which could give a decent risk reward. So ICICI Bank would be a better pick amongst all the 4 banks. I think from a longer term perspective, this is a kind of a monopoly business for them, and I think clearly the company has delivered very strongly on the numbers. They are also implementing a bigger expansion plan, which should, I think, obviously contribute to FY23 second half and FY24 incremental top line growth and profitability. So I think if the time frame is at least 2 years plus, then I think they should hold on. My sense is that they should not average at the current levels. Probably if the market corrects and the stock provides a downside opportunity, then one could accumulate. But definitely having invested here, I think keeping a 2-year view, the risk reward could definitely be very attractive. So continue to hold on because the space is definitely going to see a lot of growth considering the fact that a lot of large business groups have decided to get into renewable and solar energy. So that actually would demand a lot of domestic demand for the company. No, I think, Cheryl, this company is a very well-managed company from Gujarat, and I think like Anand Rathi, they are also having a lot of advisory and wealth management business plus the mutual fund distribution business. My sense is, since the investor has just applied, and I think the stock has not given a very decent upside from the public issue time, I would suggest that he should hold on at least for the next 12 to 15 months because once the company starts reporting quarterly numbers, starts giving management commentaries on the business, at that point of time you could see a lot of interest in this company. It's a well-managed company, but I think given the fact that very little data is there in public as of now, I would believe that it's better to hold rather than exiting at this level, because my sense is that hopefully if the markets improve from here on, mostly fee-based income would continue to grow and definitely long-term prospects are good. So continue to hold on and wait for at least next 12 to 15 months to get a decent risk reward. I think, Cheryl, if you look at the mutual fund business, one big positive for the mutual fund business is that they don't require capital frequently and it's a very high ROE generating business. Now, there are many investors who got stuck up in Aditya Birla Sunlife AMC after the public issue, but I would suggest, if the investor has got the next at least 2 years plus time frame, then I think he should use the opportunity to accumulate a little more and average a little more at the current level. The stock is definitely trading at extremely attractive valuations, and I think considering the fact that SIPs are now pretty strong and stabilized in the market. Plus, Aditya Birla Life MC is one of the larger players amongst the top three players in the industry. I would not be surprised that you could see a strong kind of growth, for FY23 and 24. So keep the patience with you, and I think definitely you should be able to get your price, but do average at the current level, which will actually reduce your average cost and get you a better risk reward in the next say 2 years. So my advice would be not to sell in panic and definitely hang on to this, but do average a little quantity and we keep a time frame of at least minimum 15 to 18 months to get that a decent kind of risk reward. If the investor has got at least the next 1 to 2 years, see, Dabur is one company which has insulated some of the inflationary cost pressures, and most importantly, we believe that in the coming year, hopefully, if the monsoon is good and if there is complete normalcy in the business, then volume growth will be pretty strong. I would suggest that if the investor wants to buy, possibly she can buy possibly in small installments, not in one lump sum amount, because considering the markets are volatile, she could get possibly a better kind of investment opportunity if she averages a cost in 3 to 4 installments. But definitely on a business side, compared to other FMCG majors, I would believe Dabur definitely has its positioning well placed. Its geographical mix and product bouquet is far more diversified, and which gives it a lot of resilience in this kind of market. So definitely, if one were to look at the next 1.5 to 2 years, this is definitely a good portfolio stock to accumulate. So I think La Opala definitely is in a very niche category, and I think if one were to look at the profit margins of this company, they have been consistently high because of the premiumization of their product bouquet. See, if the investor has a medium to long term horizon, then I think this company has a very bright future, considering the fact that this is an upmarket product with very good EBITDA margins. As far as the averaging is concerned, I think the current level also looks pretty good, but the time frame needs to be at least 1 to 2 years. I think earnings recovery will definitely come in because the company has recently commissioned an expansion, and I think we could definitely see higher volumes as well as incremental top line growth over the next say 2 years. So even at the current levels, one can average, but time frame needs to be at least 18 months plus, which should definitely give a better risk reward, considering the fact that this is a small but niche business and growing quite steadily. I think definitely Recall should do well, considering the fact that it's a very dominant two-wheeler ancillary player in the two-wheeler as well as the passenger car space. More importantly, what we saw was in the fourth quarter, margin improvement was quite significant, and the stock obviously moved up also significantly post the Q4 numbers. And going forward, the management seems pretty confident that both the passenger car and the two-wheeler business, the content per vehicle will offer a bigger opportunity for a player like Recall. I think a 4 to 5 year view, Vinny, is extremely a big time frame. But even if the investor keeps a 18 to 24 month horizon, at least the next 1 to 2 years, I think definitely he should be able to get a decent risk reward. Auto ancillaries are definitely now in the limelight, considering in the automotive sector there are significant green shoots visible. The two-wheeler sector has yet not taken off, but I would believe that possibly after the monsoon this year, we could see some sort of a good demand revival in the two-wheeler space, and that obviously would have a significant rub-off on a player like Precon. So continue to hold on, and I think keep a time frame of at least 18 to 24 months. Cheryl, I think this is a mid-cap stock which is into textiles, especially terry towels and paper. I would suggest, if the investor has 10,000 rupees to invest, I think he needs to keep a long-term view, and I think largely it is better that he focuses more on the large-cap companies. Although Trident has shown a very strong, earnings trajectory, one should remember that, in mid-cap stocks, the alpha is either on the upside or on the downside, and the volatility is also very high. So he can definitely invest in Trident if he has got a medium to long-term view. But my suggestion is that please don't ignore the large-cap stocks currently also, because the market has offered a very good opportunity to enter large-cap names like Mahindra and Mahindra, or maybe something like a L&T, which are more stable names and which can give him a decent risk reward with a maximum protection of his capital. So my suggestion would be that he should cover up both large-cap and mid-caps in his portfolio. So I think my guess is Suprajit Engineering, which is a very large player in the cable space, especially for two-wheelers. I think that would be a better bet. The company's balance sheet, the company's cash flow, and obviously the growth prospects seem to be a lot better if one were to compare it with Sterling Tools. Sterling Tools is a small player in the fastener space, but overall I think if the investor is looking over the next 12 to 18 months as a switch, then I think Suprajit Engineering would definitely present a better opportunity. It's a market leader in its product category, and our sense is that next year should be definitely a lot better compared to last year. Yeah, I think from a longer term perspective, the larger banks always will present a better opportunity for growth. Now with the credit cycle getting back into double digits, I think the banks with the larger balance sheets and with a more diversified business income would benefit. So I would suggest, that if he has a 2-year view, then I think he should definitely look at ICICI Bank, considering the fact that now the bank is all strongly positioned for very strong credit growth. And obviously, if the economy grows by 7 to 8%, the banks are going to be the key beneficiaries, especially the larger banks. So ICICI Bank would be a better choice, provided he's got a 2-year view, because the stock has definitely moved up, but it is still available at decent valuations, and where the risk reward is definitely good from a long-term point of view. From the sugar space, we have already seen a significant correction happening. Basically, market has been slightly disappointed because of the export quota for sugar companies. But I think the bigger trigger for these sugar companies is going to be from the ethanol opportunity, which I believe is going to be a very large opportunity. The current supplies are around 450 crore liters of ethanol, and whereas the demand over the next 2 to 3 years is going to be 1,000 crore liters. So I think larger players like Balrampur Chini, Dampur Sugar, or even companies which are making molasses from grains, something like a BCL Industries, which just recently announced today the commissioning of its West Bengal new distillery. I would believe that these are very good choices, provided one has a 18-month view, because ethanol is going to be a product which is going to be in big demand. The government has also increased the blending rate from 10% to 20% by FY 25-26. So I think the tailwinds are very strong. I think if the investor wants, he can even buy at current levels, provided the time frame is at least 18 months. See, I think my guess is, I think this is a company which is an ancillary player to the aluminum sector. And I think all said and done, I think I would believe that, now the kind of headwinds which are prevalent in the aluminum sector are slightly challenging. In fact, globally, Alcoa has also said that numbers in the coming quarters could be under pressure. And obviously, in the Indian market, we have seen a lot of, downside for aluminum majors, especially if you consider Hindalco. So I would suggest that it would be better if they wait for some time, because such kind of ancillary companies which are large players which supply to the aluminum industry could also see a little letdown if earnings don't catch up. So I would believe that please hold on for some time, provided the view is longer term, but possibly after the first quarter of FY23, one could get a better sense on the kind of outlook and the growth momentum ahead. So better to hold on, but fresh buying should be avoided at least till the Q1 numbers are not put out. Yeah, I think the view is over the next week. I think high on every definitely long term perspective. I think he can definitely average. If he has got a 2-year view, then I think this is a well positioned NBFC. Definitely growth prospects.
Avinash, next query is from Garima, and this one is on Infibeam Avenues. They bought the share at 20 rupees per share. Can they average for a long term view or exit now?
I think this should be exit.
Okay.
In this case, I would believe that MTR is a better option. They are looking at the next year. The big business and it's good to them.